Hello, ladies and gentlemen. I hope you are fine wherever you are. I am the Acca tutor, Mr. Jeremy Timkulu, and I hope you are enjoying my videos as we delve into these, this Acca territory. And I hope that you guys will become certified chartered accountants in a short while to come. All right. So in this week, we are actually targeting to finish three accounting standards. That is um, International Accounting Standard number 36. That is impairment of assets, and I'm sure you have just finished watching that video, and the video link is actually below um, in the video description. And then we will also, in this particular segment, we are looking at International Accounting Standard number 37, that is provisions, contingent liabilities, and contingent assets. All right. And in the next video, in the same week, that is week number 7, we're also going to look at International Financial Reporting Standard number 5, that is non-current assets held for sale and discontinued operations. So these are the three accounting standards we must cover in this week. Remember, we do not have time. So for us to cover the syllabus in as quick time as possible, we need to hit the ground running. Okay, so please just be with me. The pressure, is too much, and well, that's the way it is. All right, because accountants should learn to work under pressure. So we need to cultivate the same culture in you while you are doing your studies. All right. So I hope that the ride is not going to be stiffer for you because you are having a tutor by your side. So you mustn't complain. Okay. So without much ado, ladies and gentlemen, let us get straight to business. All right. Okay, ladies and gentlemen, as I've already highlighted, we are going to delve in IS 37 provisions, contingent liabilities, and contingent assets. Those are my um qualifications, my conduct, right? So feel free to contact me anytime when you feel like you want a tutor by your side who is going to help you to maneuver the Acca territory. Okay, so let us get into the notes. Now, this is just the background of IS 37. As you can see on the screen, the IS 37 provisions, contingent liabilities, and contingent assets was brought in to remedy some abuses of provisions. Now, this standard says that entities should not provide for costs that need to be incurred to operate in the future if those costs could be avoided by the entity's future action. So we are not going to expect um, a finance director or an accounting manager to provide for future costs which are going to be incurred by the entity. Okay, if it is possible that future actions of the manager could actually avoid those costs. So if the costs which are going to occur in future are within the control of managers, then we cannot allow them to provide for those costs. All right, don't worry, we are going to define what is to provide or what is a provision. Don't worry about that, but this is just the background of the issue. Now, cost of restructuring. These ones are to be recognized as a provision only when the entity has an obligation to carry out the restructuring exercise. Okay, don't worry, we're going to talk about what is to restructure, what is that. Then the full amount of any decommissioning costs or environmental liabilities should be recognized from the date on which they arise. That is, they should be capitalized as part of asset cost. Usually, previously, managers could only make a, a provision, and they did not uh, recognize that such such costs were actually part of the cost. So the standard has been updated to ensure that the relevant recognition criteria is has to be this way. Okay, the cost have to be capitalized as part of the cost. But don't worry, we are going to venture in, deeper into this territory as we proceed with the lecture. All right, now let's talk about the definitions, because if we do not define these terms, then our lecture is going to be meaningless. All right, now what is a provision? A provision is a liability of uncertain timing or amount. So these uh, items should not exist uh, concurrently. Okay, it is not a requirement that they should exist concurrently. Uncertain timing or amount. So the statement simply means that when the liability is of uncertain timing, all right, of uncertain timing, then you need to ensure that you recognize a provision. Sometimes the timing could be certain, but the amount is not. All right. So if the amount is not, even if the timing is certain, then of course we then have to recognize a provision, provided an estimate is available. All right. So the statement, they did not say and. Okay, it's not and. A liability of uncertain timing and amount. No, that's not the wording. But it is saying a liability of uncertain timing or amount. All right, so the amount could not be ascertained. All right, but the timing could be. So in that case, then you need to recognize a provision, which means this is different from an ordinary liability where we know the timing, both the timing and the amount. Then in that case, it becomes a real liability or an ordinary liability. But in this case, one of the two is not known, then a provision has to be recognized. Liabilities, ordinary liabilities actually. Liabilities are obligations to transfer economic benefits as a result of past transactions or events, which means when we use the word liability, we are saying there is an obligation due to past events that will lead to a transfer of economic benefits from the entity. Now, there are also, from the title of the standard, there are also these two terms, contingent liability and contingent asset. A contingent liability is a possible obligation, mark the word possible, obligation that arises from past events and whose existence will be confirmed only by the occurrence and non-occurrence of one or more uncertain future events not wholly within the control of the entity, or a present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. It is not probable. So you can see that we are also being introduced to two terms, the word possible and probable. In our layman day-to-day lives, we often use these two terms or two words interchangeably, but according to accountants, they are very different. When we are talking of probable or probability, we are simply saying that the level of certainty is now at advanced level. But when we are simply saying that an item or a situation is possible, it simply means that the level of occurrence or the probability is very, very low. Okay. All right, that's it, guys. That's how it is. That's the way it is. Okay. Now, the amount of the obligation cannot be measured with sufficient reliability. Contingent liabilities should be disclosed. So, in other words, since we cannot recognize a liability which is contingent, we then have to disclose in the notes to the financial statements unless the possibility of any outflow of economic settle, it is remote. So in other words, because it is not probable that an outflow is going to happen because of the situations surrounding this liability, we are only going to disclose it in the note. However, we shouldn't even disclose it if it is remote. We are also going to give you a tabulation for you to understand what remote means, what possible means, what probable means. Okay, I'm going to give you a table so that towards uh, the end of this video segment, you should be in a position to actually determine that this type of wording simply means that the event is just possible but not probable. Sometimes it is very remote. Okay, when you're saying remote, it means that you just have to relax. Don't do anything. Don't disclose. Don't do anything. Just go and get your cup of coffee. Now, what about contingent asset? All right. Now, a contingent asset is a possible asset that arises from past events and whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. A contingent asset should be disclosed where an inflow of economic benefits is probable. So you can see that there is a difference here. The word probable, okay, if a liability is probable, then you need to provide. Okay, when the liability is probable, you then have to provide. But when the liability is possible, you then need to disclose as a contingent liability. But when it comes to the asset now, if the asset is probable, you just have to disclose. All right? If the asset is probable, disclose it. All right? A contingent liability should be disclosed where an inflow of economic benefit is probable. Then you need to disclose. What about if the asset is possible? If the asset is possible, the statement simply means that do nothing. And then what about if the asset is remote? Obviously, continue to do nothing. Okay, so you can see that here they are incorporating the principle of prudence. All right, we mustn't be opportunistic when it comes to the realization of assets. All right, we shouldn't anticipate more profitability. In other words, we just have to be cautious. All right, otherwise capital markets would be full of scammers. Okay, would be full of scammers. So the standard setters are trying to force accountants to go prudent, to be um, conservative in the way they recognize their profitability. Okay, so ladies and gentlemen, this is just the bit. The other way, the other thing I want to point out is the aspect of contingency. All right, contingency. When we are talking of contingency, we are simply saying that uh, the outcome of an event, or maybe the decision for this particular situation is only going to be confirmed uh, with the occurrence of another, or with the occurrence of something else. Okay, so this is why we are saying it is contingent upon that this type of liability is contingent upon the occurrence of something. This asset is contingent upon the occurrence of certain event. Okay, so this is why we need to disclose these things. All right, now let's proceed with the recognition of provisions. IS 37 states that a provision should be recognized as a liability in the financial statements when, so this is the criteria of recognition. So we are only going to recognize a liability when, number one, an entity has a present obligation, legal or constructive, as a result of a past event. Now, when we are talking of legal, this means that the obligation is as a result of a contract that has been entered into by the entity and its customers or its stakeholders. All right. So it is established or enforced at law. All right. So the relationship here is enforced at law. All right. An example could be where a customer buys something in a sales contract from you, and they happen to buy something that is defaulty, and they pay you, and when they go home they discover that the asset is dead, okay, or has got some is defective. Now in that case they are empowered at law to come and return or claim a refund from you. All right. So that might lead to you to provide for such issues. All right. Now, sometimes it's not about the law, but it's about good or best business practices, where an entity is actually known of doing good to its customers. It has got over the years provided an expectation upon its customers that whenever they buy something from the company, they are allowed to return items if they find them defective. All right. So just based on previous history, we can allow a certain percentage as a provision for returns. All right. So in that case, we are also allowed or empowered by the standard to provide. So that will be a constructive obligation. It's not a legal obligation, okay? But it's something we are known, okay? We are known of doing that. All right. Now, number two, it should be probable that an outflow of resources embodying economic benefits will be required to settle the obligation. All right. So we need to satisfy that as a result of that particular transaction, we might be required to pay something to settle the issue. All right. But if we are not going to be required, why should we have to provide for it? Okay. For example, of course, the customers could have bought items which are defective, okay, but we are also told that the customers, okay, the customers have got a habit of not coming back. All right. Or the customers are so affluent. They are rich people, they are rich guys. They normally do not have the do not enjoy the trouble of coming back to us and so forth. So by the end of the day, using past history, we have never had a customer coming back to us, okay, from this particular market segment. The customers are not coming back to return anything, and we are not receiving any negative reviews about our services. So we are not required to pay anything by the end of the day. Why should we have to provide? What evidence do we have that we are likely to pay? Okay. Or maybe because the item is within the courts, okay, or the issue is within the courts, and from previous history about similar cases, we have never had a situation where companies end up paying anything to settle the matter. So in that case, it is not probable that an outflow of economic resources embodying I mean, an outflow of resources embodying economic benefits is going to occur or is going to be required. All right, so we can't provide. Item number three, a reliable estimate can be made of the amount of the obligation. We need to have some reliable estimation about the amount to be paid. Okay, sometimes we can use the discounted cash flow technique to arrive at the possible estimate. I mean, the reliable estimate, right? Sometimes you can use, if it is a long-term obligation, then the time value of money comes into play. Okay, that's it. Let's move on. We have talked about the constructive obligation. Okay, measurement of the provision. Let's talk a bit about this. The amount recognized as a provision should be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. Okay, the estimates will be determined by the judgment of the entity's management, supplemented by the experience of similar transactions. So sometimes we are then forced to utilize information from previous experiences about the similar transaction. Okay, we then have to come up with a reasonable estimate. Allowance is made for uncertainty. When the provision being measured involves a large population of items, the obligation is estimated by weighting all possible outcomes by their associated probabilities. That is, we might end up have to use the expected value technique if the population is large. For example, you are a wholesaler who has been selling maybe items to different groups of individuals, all right, at different values. So this is usually common in situations where you have warranties. Okay, you offer warranties for repairs. All right, now usually you discover that you need to come up with levels, I mean percentages of return for repairs. Okay, and when we are talking of percentage, we are simply saying values within 100%. Okay, now for example, you might say you might categorize instances. For example, major repair, moderate repairs, and then minor repairs. Now, you need then to say, what is the probability that we are likely to incur costs for major repairs of the items which are on warranty, which were sold but having some warranty for repairs? Then you discover that maybe 5% are going to require major repairs. 5% of the items which we sold are going to require repairs. Okay, for moderate, you might discover that maybe 25% would require moderate, and then 30% would require minor repairs. Okay, then you then have to say, if it is a major repair, how much does it cost? Then you discover that a major repair might require something like 20,000. Okay, $20,000, and then a moderate repair might require something like $10,000, and a minor repair might require us to incur costs which are somewhere around 5,000. So the expected value of this would be using simple multiplication and summation. So it will be the summation of this expenditure. All right. So the summation could be we start with the major. Major is 5% multiplied by 20,000, and then we add for the moderate 25% multiplied by 10,000, and then we add the minor cost, that is 30% multiplied by 5,000. So you add them and then you get the total. Okay, so if we say 5% multiplied by 20, let me use my calculator here. 0.5 multiplied by 20k, you can see that this one is $1. a dollar cost, and then 25% multiplied by $10. 25% is a quarter of $10. That is $2.50. Okay, remember these are thousands. All right, so let us put the values there in thousands. This is 1,000. This is 2.5 thousand, and then 30% of 5,000, that should be 1,500. So 1.5 thousand. So the total expected value, okay, the EV, the expected value there is going to be 1 plus 2.5, that's 3.5 plus 1.5, and you get 5,000. So this is going to be the provision. Okay, that's the best estimate. Sometimes if the provision, if the liability is going to be long term, all right, then you then have to use the discounted cash flow technique. Okay, now when the provision involves a single item such as the outcome of a legal case, provision is made in full for the most likely outcome. All right, this statement simply means that if the case is not involving a larger population, the larger population, that's why where we say that we need to use the weighting technique, okay, or the expected value technique. But if it is a single transaction or a single item, all right, for example, a single case, then the full amount of the most likely outcome is going to be provided for. Okay. Now let's look at this particular situation to proceed with our case. Moya Co sells goods with a warranty under which customers are covered for the cost of repairs of any manufacturing defect that becomes apparent within the first 6 months of purchase. The company's past experience and future expectations indicate the following pattern of likely repairs. Okay, we've got percentage of goods sold, the defects, the cost of repairs if all items suffered from these defects. All right, so we are having the percentage here. All right, and we have indicated that we need to use these percentages as part of our computation. So here we are talking of 75%. Okay, 75% are going to have no defects, so these ones are going to be 0. Okay, then 20% are going to suffer. All right, 20% are going to suffer minor defects. So 20% multiplied by 1 million, here is multiplied by a 0, that's why we get the 0 here. So the provision we have to provide for here, that's a 0. Okay, and then 20% multiplied by a dollar, that's 0.2. Okay, and then 5% multiplied by 4. Okay, yeah, let me just use my calculator again. Multiply by 4, that's 0.2. Okay, remember these are $1 million. All right, these are million. So you add up, you can see that the provision required should be 0.4 million or 400,000. Okay, so that's how you have to determine the provision. Okay, let's move on. We have indicated that time value of money sometimes matter. When the effect of the time value of money is material, the amount of a provision should be the present value of the expenditure required to settle the obligation. Okay, an appropriate discount rate should be used. The discount rate should be a pre-tax rate that reflects current market assessments of the time value of money. So managers consider what is happening in the market, what are the key variables. For example, maybe the COVID issues, all right, the post-COVID economic issues, okay, and the borrowing costs, all right, I mean the interest rate and so forth. So by the end of the day, they then consolidate those variables and come up with an appropriate discount rate. The discount rate should not reflect risks for which future cash flow estimates have been adjusted. You will be given any relevant discount rates in the exam. Now, if we are being told that the discount rate should not reflect risks for which future cash flow estimates have been adjusted, we are simply saying that if we have already adjusted for any risks, so it means that we are only going to consider current market assessment, not future, not future risks. So when we do an assessment, we shouldn't bank on the worries of an upcoming election, okay, or of an anticipated war. We do not consider those items when we make an assessment for the appropriate discount rate. We need to consider things which are obtaining on the ground. Okay, so this is why we are using this statement. You mustn't factor in factors which are beyond the manager's control, or maybe which are not evidenced by what is happening in the market right now. Of course, the market sometimes tend to be forward forecast, okay, but the standard wants us to factor issues which are already obtaining in the ground. But don't worry, it's Acca financial reporting. You are going to be given the discount rate in the exam, so don't worry. But you need to have this background theory that the discount rate should be a pre-tax rate that reflects current market assessment of the time value of money. Okay, don't worry about things which are yet to come. All right, let's move on. Let's try this example and see if we can make sense out of this um, time value of money gospel. All right, a company knows that when it ceases a certain operation in 5 years' time, it will have to pay environmental cleanup costs of 5 million. What amount will appear in the SPL and SFP in the first 2 years? We are also going to cover this aspect in detail with two more examples. All right, here we just want to illustrate the time value of money concept. All right, so let us give it a try and see if we can get somewhere. Okay, let us try to see if we can get somewhere. Okay, I'm glad you have determined that there was no discount rate. Okay, so like I said, in the exam you are going to be given the discount rate and as well as the discount factors. Sometimes they give you the discount factors, okay, but if you want to know how to calculate the discount factors, you can as well refer to the video which I did on IAS 36 impairment of assets, right? But now we can touch some of those issues here. All right, now we are told that they will need to pay 5 million. All right, they will need to pay 5 million as environmental cleanup costs, right? And we are required to show extracts within the SPL and SFP for the first 2 years. All right, and we are also told that the operation is going to end in 5 years' time. All right, let us use the discount rate of 10%. Right? Let us use the discount rate of 10%. Right, so you can see a provision is required, but we are saying if it is a long-term provision, obligation, then we need to use discounted cash flows. Okay, discounted cash flow technique. All right, so for year one, in year one, sorry, year one. All right, the year one, we are going to say what is the PV, the present value of 5 million in 1 year. All right, so PV is equal to 5 million multiplied by the discount factor of 10%, 5 years. 10% 1 year. All right, so 10% 1 year, that's 1 over 1.1 to the power 1. All right, okay, but now I need you to see this. Do we have to say to the power 1 or to the power 5? In this case, we need to say to the power 5. Why? Because we are saying this is a 5 million we are going to pay in year 5. Am I talking to somebody? We are going to pay this money in year 5, not now. Okay, we can't do the cleanup cost now, but we need to provide for this particular cost because we are going to incur the cost. All right, and it is beyond the manager's control. It is required by legislation, so we need to provide for it. All right, sometimes it might not be required by legislation, but because the command has put upon its shoulders to do something that is constructive, something that is going to make our environment a better place. So this command could be believing in that, and it is known of doing such things. So that will be a constructive obligation, and the standard allows that. So we are going to pay this money in 5 years' time. So we can't say to the power 1, but to the power 5. Now let's do the computation. Let me also use my calculator. All right, so we are going to have 5 million multiplied by the discount factor of 0.62092, which is going to give us how much? 3,104,660. 600. Okay, there are 2 zeros there. Okay, so that's, I said this one is a 6. All right, so that's for year 1. We are going to recognize a provision for this amount. What about year 2? In year 2, what are we going to do? Okay, in year 2, we are going to use the same figure. Okay, in year 2, the present value will be 5 million multiplied by 1 over 1.1 or 1.10 to the power 4. Remember, 1.1 is the same as 1.10. Okay, somebody would be confused and say, where is the 1.1 coming from? Remember, when you are calculating discount factor, it's 1 over 1 plus r to the power n. Okay, so the r is 10%. So 1 plus 10%, 10% is 0.1. So 1 plus 0.1, that's 1.1. Are we together, ladies and gentlemen? That's 1.1. All right, so let's move on. Let me use my calculator now. So it becomes 5 million multiplied by 0.683 3101. And when we punch in our calculators, it becomes 313415050. Okay, so you can see that the amount is increasing and increasing until it reaches 5 million. All right, so what is happening? What is happening? What are we going to do about the increase? Okay, let me use my calculator and determine how much was the increase. The increase in year 2 was 310,450. That's the increase, isn't it? All right, so the increase here is what we call the unwinding of the discount rate. We treat this as a finance cost. It is equivalent to 10% of the original discount rate. I mean the original present value of 3104600. Okay. Okay, this becomes 310460. Okay, don't worry about the difference, the slight difference between these two numbers. Okay, these two figures. Okay, it's just an issue of rounding. Okay, but you can see that they are the same. So this is just the bit, I mean a bit of what we are also going to see in the following examples. All right, now the question was saying which amounts are going to have, to be found in the statement of profit or loss and statement of financial position. Okay, so let us try to determine those two figures. All right. Okay, we're expecting this scenario in our books. All right. All right. I'm trying to find the space. All right, the space cannot be found. Now, okay, in year 1, our non-current assets, the non-current assets, all right, our non-current assets should have the cost, the cleanup cost capitalized, or added to the non-current assets. Okay, so they should be added. Okay, at what value? At the present value, this 3104600 should be added. Okay, and it should be depreciated. Now, when you have added the cost to the cost of the non-current assets, obviously they have to be depreciated in terms of the period of the cleanup cost. I mean the period to the cleanup cost. In this case, this cost is to be depreciated for 5 years. Okay, the duration of the operation. Okay, so that's what is going to happen. Now, what about in year 2? So obviously we expect that in year 1, again the SPL, this is the SFP, right? The SPL should at least show the depreciation charge. Okay, depreciation will be this valued, the 3104600 value divided by 5 years. Okay, and we get our depreciation value for year 1. That is the cost that is to be charged. All right. Now, what about year two? In year two, we expect, sorry, I'm writing on top of figures. In year two, um, we expect the non-current assets to now um, have the the cost, the cleanup cost, all right, reduced by the depreciation, okay, and reduced again by um, the depreciation for the current year too. Okay, so we expect to see the cost less accumulated depreciation. Okay, all right, and then what about for, we also have got um, the liability side. Okay, I'd forgotten. In year one again, we needed to have. Um, I've only spoken about the non-current assets. There is also the provision side. Oh, sorry. The provision. Okay, the provision will be the same as the non-current asset value. Okay, the provision for year one will be just the same with the non-current asset value, right? But in year two, we expect to see the uh, the provision side. The provision would be this amount for year two. Okay, that's the amount for year two. It will be the provision, the original provision plus the unwinding. The unwinding of the discount rate. Okay, the original PV plus the unwinding of the discount rate. Okay, so it will be original PV. This is year two, remember, plus the unwinding, this 310 450. Okay, that's for year two. Then in the statement of profit or loss, in the SPO year two, we expect the depreciation charge original plus the finance cost, which is this the unwinding, okay, the 310 450. So that's how it goes, ladies and gentlemen. Don't worry, we are going to do another example about this area. Okay, so that's the idea. For now, let's move on. There are what are called onerous contracts. A onerous contract is a contract entered into with another party under which the unavoidable costs of fulfilling the terms of the contract exceed any revenues expected to be received from the goods or services supplied or purchased directly or indirectly under the contract, and where the entity would have to compensate the other party if it did not fulfill the terms of the contract. If an entity has a contract that is onerous, the present obligation under the contract should be recognized and measured as a provision. An example might be vacant leasehold property. The entity holding the lease is under an obligation to maintain the property but is receiving no income or benefit from it. So we are simply saying a onerous contract is a contract which you can't do anything but to fulfill its conditions, even if you're not getting a benefit out of it. For example, you are leasing a building, okay, you are renting a building, but there is a spare room, or let me just say there is a vacant room which of which you pay rent, but you are not benefiting from it. Okay, you are not allowed to sublet. You're not. It is just a cost for you. All right. So you are required by the standard to provide for such a cost. Okay. So let us try this particular example to send the point home. In June 23, I don't like the screen how it is appearing. Okay. In June 2003, a company's board of directors made a decision to close one of its factories, in which it rented a number of machines. Okay, it rented a number of machines under short-term leases, which have an average of 3 months to run after 3rd September 2023. The present value of these future lease payments at 3rd September 2023 was 1 million. However, the lessor has stated that they will accept 850,000 if paid on 3rd October 2023 as a full settlement. Penalty payments due to the non-completion of supply contracts are estimated to be 200,000, 50% of which is expected to be recovered from company's insurers. In respect of the leases and penalty payments, what provision is required in the statement of financial position of the company as at 8 September 2023? Okay, you can pause the video and try this question on your own. Okay, we are seeing that this question has got a one-hour contract. Okay, this is a one-hour contract, but there is also an issue of insurance receipt. Okay, all right. Although there is an upcoming standard, it is already there, but it's not yet examinable at the FR paper or within the Acca FR paper at the moment. That is IFRS 17. Okay, there is IFRS 17 that is in place, which talks about insurance contracts. All right, but you are not actually being led to that standard with this information. Okay, there are other standards which apply to this particular transaction. Okay, the insurance receipt. All right, you can work with IFRS. IFRS 9. Okay, you can consider this one as a receivable. Okay, it is a receivable actually. Okay, all right, but the most appropriate one is actually IS 37. It is an asset, I mean a contingent asset. Now the question that comes is, how contingent is this one? Is it probable? If it is probable, then you need to disclose. Okay, if it is probable, then you need to disclose. And in that case, if it is an issue of disclosure, then that answer is out. Okay, or that option is out, because the options which we are given by the examiner are actual figures. Okay, they are actual figures. So if they are actual figures, then the asset should be actually an asset. So it should be virtually certain that the insurance is going to give us money. Okay, but according to this, they are expected. They're expecting to be given money. Okay, they are expecting to be given money. All right, and then if they're expecting, maybe it's virtually certain that they're going to be given the money. All right, so we expect to see that the money is going to have an impact. But what type of an impact shall we expect to see in this case? If we are having an insurance receipt, okay, there is a trap that you may think that that money has to be set off against the insurance or against the damage or the liability. In this case, you are not allowed to set off these receipts. Okay, insurance receipts are not going to be set off against the damage. All right, a receipt has to be accounted for. Okay, as maybe income. All right, to be just other income. All right, you are not required to set off the damage against the insurance receipt. All right, so the impact of the insurance in this case is going to be ignored. So what are we going to then do? All right, we are going to recognize the onerous contract. Right, the onerous contract here is going to be based on the amount which the lessor is expecting. Okay, he has allowed us to say, if you guys pay 850,000, I'm going to be okay if you are going to pay this amount by 30 August. I mean 30 October. I'm going to be fine. So we're going to recognize the onerous contract. How much? 850,000. Okay, plus how much now? Now, like I said, you are not required or you're not allowed to set off whatever, even if the insurance is going to be highly, or I mean, virtually certain that we're going to receive the money. Okay, even if it is virtually certain. In any case, we then have to recognize an asset, a real asset. Okay, that is, we recognize that as a financial asset under IFRS 9. Okay, we need to recognize that as a financial asset under IFRS 9. In any case, it will be a receivable. So here, even if we are going to recognize that, then in answering the question, because the question is saying in respect of these leases, penalty payment and penalty payments, what provision? Here we want to recognize a provision. What amount are we supposed to recognize? All right. So I'm saying we recognize the onerous contract, okay, because we have got a lease that is in subsistence. We are required to pay, even if we close the factory, we need to pay this lease. So 850, the rental is required, okay, plus the penalty payments, okay, the penalty payment of how much? Of 200,000. Regardless of the fact that we are going to receive something, 50% of that amount from the insurance, the standard does not allow us to set off this amount. So the full 200 is going to be part of the provision, and we are going to have a total of 1,050,000. So the answer, ladies and gentlemen, is C. Okay, yeah, that's the way it is, ladies and gentlemen. We just have to be comfortable with it, but we need to move. Okay, let's move. Now, like I said, we need to explore further the area of decommissioning or abandonment costs. Okay, so we touched a bit about it, but we need to at least explore this area with at least two more examples. When an oil company initially purchases an oil field, it is put under a legal obligation to decommission the site at the end of its life. Prior to IAS 37, most oil companies set up the provision gradually over the life of the field so that no one would be unduly burdened with the cost. IAS 37, however, insists that a legal obligation exists on the initial expenditure on the field, and therefore a liability exists immediately. This would appear to result in a large charge to profit or loss in the first year of operation of the field. However, the IAS takes the view that the cost of purchasing the field in the first place is not only the cost of the field itself, but also the cost of putting it right again. Thus, all the costs of decommissioning may be capitalized. And when I say capitalized, it means that they become cost of the non-current asset and they are subjected to depreciation, even impairment. Okay, so they have to be depreciated. Now, let's move on. I guess we have got a question there. Yes. Danglong operates a thermal power station. The power station is due to be decommissioned on 31 December 2008, but will be fully operational up to that date. It has been estimated that the cost of decommissioning the power station and cleaning up any environmental damage as required by legislation will be 60 million. Danglong recognized a provision for the present value of this expenditure at 31 December 2020. A suitable discount rate for evaluating costs of this nature is 12%, equivalent to a present value factor after 8 years of 0.404. The decommissioning cost will be depreciated over 8 years. What is the total charge to profit or loss in respect of this provision for the year ended 31 December 20x1? So, ladies and gentlemen, remember we are in class and we are exam focused. We are here to give you exam tailored examples so that you are not going to be found wandering on exam day. All right, so please pay careful attention as I do these computations. Okay, let's now play with the figures, ladies and gentlemen. I hope you guys are now ready, or you have tried the question on your own. That's fine. Okay, so you can see that here we need to have a provision for decommissioning costs, and these guys have already done that on 31 December 20x0. They determined the PV of the cost, and these were 60 million. Okay, 60 million multiplied by the discount factor at 12%. That is 12%, 8 years. Okay, 8 years, that's 0.40, 0.404. Okay, 0.404. Okay, and I said to obtain that discount factor, that's 1 over 1.12 to the power 8. So let me try with my calculator. That's 1 over 1.12 to the power 8, and we get the same amount. But remember, there is some issue of rounding. The calculator is saying 0.40388. Okay, so the examiner has rounded up to 4 decimal places. I mean to 3 decimal places. Okay, now if you multiply 60 million by 0.404, you must get how much? The calculator, 0.404 multiplied by 60 million. That's 24 million. 24 240. Sorry. 240000. Okay, 24,240,000. That's the present value. Okay, now when you know the present value, we then have to say what is 12%, because in year 1, now year 1 is another year from year 0, from 20x0. Okay, that's year 2. Okay, so in year 2 we need to unwind. Okay, we need to unwind the discount rate. So what are we going to do then? We then have to say 12%. What is 12%? Okay, let me just say 12% of 24 million 240. I'm taking this. This is the 24 million I'm referring to, ladies and gentlemen. 24,240,000. Okay, that's the 24 million I'm referring to. Okay, so this calculator, that's 2.9 800. Okay, and like I said, that's a finance cost. Okay, this is the finance cost. So obviously, when the question says what is the total charge to profit or loss, it is actually saying what are the necessary charges related to this transaction which have to be found in the statement of profit or loss. Okay, so we know that there is the finance charge. We also know that there is need for depreciation. Okay, so what is the depreciation charge? So far we have determined the finance cost of 2.908 million. Now the depreciation should be based on the lifetime of the project or lifetime of the operation. So in this case, depreciation is also based on the present value. The original present value was 24,240,000, and this project is for 8 years, so divided by 8. So that's how much? That's 3,030,000. So this is the depreciation. So the total charge to be transferred, we need to add these figures 0088395. So the total is 5.9388 million. So you can see that our answer is that one. Okay, maybe this one is not enough. Let us then try this other question and see if we can say we are condemned. Okay, Protein is a company that carries out many different activities. It is proud of its reputation as a caring organization and has adopted various ethical policies uh, towards its employees and the wider community in which it operates. As part of its annual financial statements, I want you to see that the aspect of constructiveness, constructive obligation, not legal. Okay, Protein is a company that carries out many different activities. It is proud of its reputation as a caring organization and has adopted various ethical policies towards its employees and the wider community in which it operates. As part of its annual financial statements, the company publishes details of its environmental policies, which include setting performance targets for activities such as recycling, controlling emissions of noxious substances, and limiting use of non-renewable resources. The company has an overseas operation that is involved in mining precious metals. These activities cause significant damage to the environment, including deforestation. The company incurred cost of 100 million in respect of the mine, and it is expected that the mine will be abandoned in 8 years' time. The mine is situated in a country where there is no environmental legislation obliging companies to rectify environmental damage, and it is very unlikely that any such legislation will be enacted within the next 8 years. It has been estimated that the cost of cleaning the site and replanting the trees will be 25 million if the replanting was successful at the first attempt, but it will be probably necessary to make a further attempt, which will increase the cost by a further 5 million. The company's cost of capital is 10%. So you can see that the question is actually exam standard. Now it is saying, discuss whether a provision for the cost of cleaning the site should be made and prepare extracts of the financial statements. So this makes the case very interesting one. Okay, it becomes a very interesting case. Okay, but we need to point out certain things there within this question. Okay, I'm sure we can see that there is a discount rate that has been given as 10%. We then have to say, I mean, to determine the number of years. Okay, number of years. Sometimes they might be necessary for us. Okay, we are told that the company initially incurred 100 million to purchase this mine. Okay, and it is expected that the mine will be abandoned in how many years? 8 years. All right, the mine is situated in a country where there is no environmental legislation. We've talked that this is a constructive obligation because based on past history, the company is an ethically compliant company. So it doesn't wait upon the legislators to come with a bill. They know what are called best business practices. All right. So even if they are operating in a country which doesn't value or which doesn't consider it important to have environmental legislation, this company is obliged, is self-obliged, okay, to just do the right thing. Okay, so it has been estimated that the cost of cleaning the site will be 25 million. However, we need an additional 5 million to ensure that everything is up to standard. Okay, so that's almost 30 million. Okay, that's 30 million of the amount to refurbish the environment. Okay, so using the same technique, you can actually see that it is very easy to attack a question of this type. Okay, so let us give it a go together. Okay, all right, let me try to find a pen. That is this one. Let me try that. I mean, oh, that one is the highlighter. Okay, ladies and gentlemen, I need to point out that since we've bought a mine, okay, then the mine is actually going to be accounted for. Communicate capital costs of in respect of the mine. So expenditure for the mine, this was capital expenditure, and usually involves the procurement of machinery and so forth. So we can account for this under IAS 16. Okay, so that cost should be capitalized as non-current assets. Okay, under IAS 16, presumably. Okay, and we have already pointed out that the discount rate we are talking about is 10%, and the assumption is that this is a pre-tax discount rate. Okay, that's the assumption. However, in the exam, and the examiner gave you the pre and post-tax discount rate, always use the pre-tax discount rate. Okay, always use the pre-tax discount rate. And if they have given you a post-tax discount rate, you then have to adjust that discount rate back to a pre-tax level. Okay, but for this examination, you need not to worry. Okay, just assume that the discount rate that has been given is pre-tax. Okay, but if you are doing the Acca SBR, please expect the task of adjusting the discount rate to pre-tax discount rate level. Okay, what other thing we need to worry about there? So to attack this question, all right, to attack it as nicely as possible, I think we need to go by double entries. Okay, let us use the double entry technique. What is going to happen? Because the question is saying discuss whether a provision for cost of cleaning the site should be made and prepare extracts of the financial statement. Obviously, the provision is to be made. All right, the provision is to be made because uh, it is going to be made because the command has a constructive obligation to do the right thing. Okay, even if it is if even if the mine is situated in a country that doesn't value environmental rehabilitation, the command has put upon it, upon itself to do the right thing. So there is a constructive obligation, and therefore a provision has to be given. How much is this provision? That's the meal of the day. Okay, so the first double entry, ladies and gentlemen, let me use a very clear pen. Okay, so our first is to recognize a provision. Okay, how do we do that? We are going to recognize both a provision and a non-current asset. Are we together, ladies and gentlemen? So we are going to say uh, debit non-current asset with that component, okay, with that component of the provision, okay, or let me just say with the provision, decommissioning, I mean the environmental cleanup costs. Let me just say in bracket because the examiners would want to see environmental cleanup cost. All right, and then you're going to credit, okay, the provision, right? Provision. But now this provision, um, sorry, we need then to calculate the amount. We are told that the amount is 30 million, but however, we need to calculate in present value terms. So the present value, 10%, 10% 8 years, that's 1.1 to the power 8. 1.1 to the power 8. Okay, is it so? Yes, because we are looking at 8 years. All right, so that's fine, and the discount rate is 10%. Okay, so I'm right on track. It's just interesting, ladies and gentlemen. Okay, so you don't no need to panic. Let us use our calculators and see if we are going to get the right thing. All right, all right, so that's 13,000, I mean 13 million 995. I'm calculating in thousands, so you can just put thousands there so that the examiners will see what you are doing. Obviously the non-current asset will be the same amount, 13995. And always know how to write this amount there. I mean, just put your, I mean, the sign or the level of denomination. All right, because if you don't put that apostrophe, the exam, some, I mean, some markers would be, um, I mean, disappointed. Okay, they will be annoyed. Actually, they will be annoyed. So just put the apostrophe there, dollar sign apostrophe, and your 3 zeros, okay, to show that the values below are in thousands, which means that's 13,995,000. $13,995,000. All right, so that's our first double entry there to recognize a provision and an asset, a non-current asset upon its inception. Then, um, what is going then to happen after a year? Okay, what is going to happen after a year? So at the end of the year, we expect to recognize two costs, the depreciation charge as well as the finance cost. Okay, so let's us recognize the depreciation charge. Okay, so depreciation is a cost, so we debit depreciation. We debit depreciation. Okay, um, how much are we looking at? We are going to be led by the total, I mean, the cost of the asset. All right. All right. So whenever you calculate depreciation, you need to know that depreciation is going to accumulate in an account, into an account called accumulated depreciation. So credit accumulated depreciation. Okay, and our accumulated depreciation had a zero. Remember, zero balance. Okay, remember this is the first year. All right, so we are expecting that in this account we are only going to find the, I mean, this year's depreciation. All right, so what was this year's depreciation? We need to find out. It is based on the cost of the asset. uh, the 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 ordinary asset was actually 100 million. Okay, 100 million was the ordinary asset, plus the environmental cost, these ones now, which are 13,995. Okay, so which means in our year one as well, we were also supposed to have these costs um, recognized or capitalized as well. So our year one is going to have also this one, debit and non-current assets. In this case, mine can just say mine equipment. Okay, the mine equipment was how much? It was 100 million. Okay, remember we are using thousands. All right, and we had bought this one with our cash. Okay, credit cash, how much? 100 million. Sorry, that's 100 million, 100 million. So those are the transactions which occurred, which means we could actually have just uh, amalgamated this double entry to include even the environmental cleanup cost. All right, in any case, we should have actually written it as debit NCI in bracket mine equipment and environmental cost, and that was going to be 113,995. Okay, and credits, we're going to have two credits now because this, you can't mix cash and that one. So we're going to have credit cash 100,000, and then credit again provision 13,995. Okay, we could have done this. All right, but I'm sure what is important is you need to know where we are going and where we are coming from. All right, you mustn't be confused with uh, some of these things. Okay, some of them are, all right. Am I talking to somebody, or you guys are now being annoyed? Please cheer up. Okay, cheer up. Now we then have to know that since we are saying the total cost, our total cost is now um, all right, the way I've written this 100 is going to confuse somebody again. I know you guys. Okay, I'm saying 100,000. Why? Because we are reporting in thousands, but we know that that 100 is 100 million plus 13,999,000. All right, all divided by 8 years, because this is an 8-year project. Okay, so that's 8 years. So let us determine the annual depreciation there. This is 14,249. So the depreciation charge is also 14,249. This is depreciation charge. Okay, so we are done. We are still in year one, but this time is at the end of year one, or at the reporting date. We expect to find depreciation charge in the statement of profit or loss of 14,249,000. We also expect to see the provision, okay, and the non-current assets. We also have to see the mine equipment is a non-current asset in the statement of financial position. All those are expected. Okay. Then the last thing we expect is the finance cost, which we expect to find. And I say that the finance cost is the unwinding of the discount. The unwinding of the discount. Okay, so what are we going to debit? We debit the finance cost and credit provision, that is unwinding, the unwinding of the discount, unwinding the discount rate, or of the discount rather. Okay, unwinding of the discount. Okay, now we are saying here the rate was 10% multiplied by the present value, the original present value, which was 13,995. We know we are talking of millions, so don't be confused. Now the 10% of that amount is going to be 1,399, or it's going to be rounded up to 1,400. So the finance costs are also going to be 1,400. Sorry, 1,400. Those are the finance costs which are going to be reported. So the items which are going to be found in the statement of profit or loss are this one and that one. Those are the costs we expect to find in the income statement. Now let's then write these issues in a more clearer way. Okay, let us now talk of the extract. Let's start with the statement of profit or loss extract. Okay, so here we expect to find, like I said, the depreciation charge, the depreciation charge. Okay, these costs, it depends with the company policy. Some of them recognize depreciation charges as part of the cost of sales. Some consider them depreciation, administrative expenses, some operating expenses. So, all right, don't worry about that. Just know that the depreciation charge is a profit or loss item. Okay, so the depreciation charge, we've determined it to be 14,000. 14,000 how much? 14,249. We also expect to see the finance cost. Finance cost, these were 1,400. Okay, these are costs. We can put them in negative, okay, in brackets. Now, what about the statement of financial position? The statement of financial position is going to have non-current assets. Okay, the non-current assets, in this case, mine equipment, is going to be something like 100 million. Okay, 100 million. um, and then the, the environmental cleanup costs are also going to be added. So in that case, let us just say total mine cost can just say the mine. The mine includes 100 million plus the 13 point how much? Plus 13.995 million. 0.995 million. There's a point there, which means it's 113,995. Remember, we are reporting in thousands. Always put that notation. Okay. What else do we have to include? We then have to deduct, because we need to consider the depreciation as well. So remember, that was the cost, mine cost. This one is the cost. Then we need to less the accumulated depreciation. The accumulated depreciation, we determine the accumulated depreciation as how much. The accumulated depreciation was this much, 14,249. Okay, so that's 14,249. We then have to deduct and get our final figure. Let me punch this 113,995 minus 14,249. That's 99,746. Okay, 99,746. That's a 6 there. It's not a C, it's a 6. Okay, it's a typo. All right. That's it for the statement of financial position. I'm sure we are now together. All right. If we buy the equipment at the start of the year, all right, in year one, all right, but then at the reporting date, we then have to unwind the provision because a year has passed. Okay, so we have to unwind the provision. Okay, so this is why in year one here we are having the finance cost. Sometimes the equipment is bought at the end of year one, then obviously the unwinding is going to start in year two. You just have to understand the flow of the question. Sometimes you need to prorate these costs. Okay, sometimes you need to prorate them, because if you don't prorate, you're going to face trouble. Okay, so you need to understand the time periods, the dates, because remember, you're going to write an examination which has got a particular period. Okay, and it will be actually having real debt, right? For example, if you are writing in September, obviously the required financial statements of financial positions will be as at somewhere around June or somewhere around July. So it's actually time fixed examination. Okay, it's based on the time, real time. Okay, it's a time relevant examination. So the dates are very important. You need to make sure you accustom yourself with the dates. All right, what about the other side of the statement of financial position? We've only listed the non-current assets. What about the liabilities side? All right, now under the liabilities, we must have something to offer for the liabilities. Otherwise, we are going to be lost. So the liabilities we are talking about are the non-current liabilities. Provisions are considered non-current liabilities. Okay, because of the aspects of timing. Remember, those are the aspects of timing. Okay, Now, here we are going to have the cleanup, environmental cleanup costs. Okay, so environmental provision. Okay, the environmental provision is going to have the original present value 3995 plus the unwinding. Okay, plus the unwinding. Remember, the 3995 was at the date when we acquired the property. Okay, the 13995 was recognized as the present value of the obligation. However, at the end of the year, we need then to include the finance cost element, that is the unwinding of the discount, and this is now 1400, and we need to add and find 15 395. So this is the amount of the provision, environmental provision, at the end of the year. Okay, ladies and gentlemen, I'm sure we are together in these computations and nobody is being lost. Okay, now let's talk about other issues here and see if we can finish this in the quickest possible time. Provisions for restructuring. IF 37 defines a restructuring as a program that is planned and is controlled by management and materially changes one of two things: the scope of a business undertaken by an entity, the manner in which that business is conducted. All these are going to be changed whenever a restructuring exercise is going to be undertaken. The IS gives the following examples of events that may fall under the definition of restructuring. Number one, the sale or termination of a line of business, the closure of business locations in a country or region, or the relocation of the business activities from one country, region to another. Changes in the management structure, for example, the elimination of a layer of management. Fundamental reorganizations that have a material effect on the nature and focus of the ent's operations. So these are examples of restructuring exercises. So your duty or your objective in the organization, in the examination, is to ensure that when you see this type of wording being presented in your question, just think of the restructuring issues. Now, there are conditions which should prevail when a reconstruction provision has to be recognized. The question is whether or not an entity has an obligation, legal or constructive, at the end of the reporting period. For this to be the case, an entity must have a detailed formal plan for the restructuring. It must have raised a valid expectation in those affected that it will carry out the restructuring by starting to implement that plan or announcing its main features to those affected by it. So sometimes the examiner would talk about these restructuring issues, and you as a clever student, you might be in a position to actually determine or decipher that something is related to a restructuring provision. However, you then have to ask yourself, has an entity made a formal plan for the restructuring? What is a formal plan? A formal plan is like a minuted board meeting, okay? When the board minutes, or there is a memo, okay, that is outlining the restructuring exercise, then obviously a memo from the board or from the company secretary that has been published by the PRO office, then that becomes a formal issue, not something that is just being spoken by individuals on the company group, social media, and you think that that's a formal plan. No, it should be documented formally, then it must have raised valid expectation in those affected that it will carry out the restructuring, starting to implement that plan or announcing its main features. So the issue of communication, it has to be communicated to the stakeholders. Okay, so by formal plan, we are saying the board has to be involved. So the board has to be involved, and the stakeholders affected should be uh, informed of the decision. Now, a mere managerial decision is not normally sufficient. Management decisions may sometimes trigger recognition, but only if earlier events such as negotiations with employee representatives and other interested parties have been concluded, subject only to management approval. So it should be actually tangible that something is going to happen. When the restructuring involves the sale of an operation, then IS 37 states that no obligation arises until the entity has entered into a binding sale agreement. This is because until this has occurred, the entity will be able to change its mind and withdraw from the sale even if its intentions have been announced publicly. So until the sale agreement has been concluded, then we can actually say a restructuring exercise, provision should be recognized. All right. What are the costs to be included within a restructuring provision? IS 37 states that a restructuring provision should include only the direct expenditures arising from the restructuring, which are those that are both necessarily entailed by the restructuring, okay, not associated with the ongoing activities of the entity. The following costs should specifically not be included within a restructuring provision. So this one must not be included. Number one, retraining or relocating continuing staff. This should not be included. Marketing should also not be included. Investment in new systems and distribution networks. These again should not be included. Why? Because they are not directly they're not direct expenditures. Okay, they're not directly linked to the restructuring exercise. Okay, so they shouldn't be part of the provision. Okay, so we are saying these three should not they should not be included within a restructuring provision. Now let's move on. Let's talk of contingent liabilities and contingent assets. An entity should not recognize a contingent asset or liability, but they should be disclosed. So whenever you see a contingent liability or a contingent asset, you then have to disclose it. The required disclosures for contingent liabilities are a brief description of the nature of the contingent liability, an estimate of its financial effect, an indication of the uncertainties that exist, the possibility of any reimbursement. In case of a contingent asset, only when the realization of the related economic benefit is virtually certain should the recognition take place. At that point, the asset is no longer a contingent asset. Otherwise, if the realization is only probable, simply disclose. If it is possible or remote, don't disclose, just do nothing. So we only have to recognize a contingent liability if it is virtually certain. I mean, we should recognize an asset if it is virtually certain, if virtually certain, or if we are almost 95% and above sure that we are actually going to receive the money, then we can say we have got an asset. Okay? We have a contingent asset. So if we have got a contingent asset, if we are virtually certain that we are going to receive 95, we are going to receive an asset or something that is economically valuable. It might be goods, it might be money. Okay, if we are 95% certain that we are going to receive, then we need to disclose that virtually certain. Okay, and then if it is okay, just a minute. All right, let me just rephrase this. If we are virtually certain that we are going to receive an asset, or we are going to receive something, be it money or goods. If we are actually certain that we are going to receive an asset, then we should recognize an asset. Okay, for example, if it is a receivable, okay, and we are quite certain that we are going to be paid by the customer, then we have to recognize a receivable. Okay, if it is a dividend that we are going to receive, we actually have to recognize that as our money. Okay, we just have to recognize the real asset which we are going to receive. Okay, you should remember that in terms of IFRS 9, okay, in terms of IFRS 9, you might be having an investment in equity instruments, dividend paying instruments, okay, for speculative purposes and so forth. Those ones, when it is possible that you're going to get the money, you have to recognize them as assets. Okay, they are financial assets. Okay, so you need to recognize them as the actual asset if you are virtually certain that you are going to receive something. In the case of the insurance receipt, which we talked about earlier on, if you are going to receive something, you are 95% sure that you are going to receive something, you need to recognize the actual receivable, the asset, the financial asset. Okay, but now if you are just 50% to 95% sure, then we can say that the asset is probable. You can receive the asset. In that case, you then have to disclose a contingent asset. Okay, I think the contingent asset has been understood. Okay, the contingent asset itself is disclosed, but when it becomes virtually, when it becomes virtually certain that we are going to receive something, then we need to recognize an asset to recognize is to put it in the statement of financial position. Okay, and I gave an example of shares which are held as an investment. If we have such type of an asset, if there is a likelihood that we are going to receive such shares, okay, then we are going to recognize an asset. Okay, we're going to recognize an asset. All right, so it becomes under the remit of IFRS 9. Okay, but if we are not, if we are only, if the receipt of those shares is simply probable but not virtually certain, then we need to to disclose a contingent asset. If it is only possible or remote, then we have to do nothing. All right, so there is a table I want you, ladies and gentlemen, to see. Okay, this is the table, ladies and gentlemen. When you are saying virtually certain, we are saying we are 95% sure. Okay, 95 plus percent sure that we are going to enter into such a transaction. If we are saying probable, it means we are from 50% to 95% sure. Or let me just say 94% sure. 50 to 94%. Then possible, we are simply saying we are okay, 5% to 49%. And then remote, we are below 5%. We are below 5% sure. Okay, that's the idea, ladies and gentlemen. Now, if we are 95% sure that we are going to incur a liability, therefore, obviously, we need to provide. Okay, we need to provide. So we need to make a provision. Okay, if we are probable, if the liability is probable, then we need also to provide, which means a provision is required. But if it is possible, then you need to disclose, because you need to disclose a contingent liability. Remember, by definition, a contingent liability is a possible obligation, okay, which is going to be confirmed by the occurrence of certain events. Then if it is remote, you must do nothing. All right? Then what about when you are virtually certain that you are going to receive an asset? Remember, liabilities are outflows. These are outflow. Assets are inflows. So if you are virtually certain that there's going to be an inflow, then obviously recognize asset. You don't provide for an asset, you recognize an asset. If it is probable, disclose a contingent asset. What about if it is possible? You need to do nothing. Here you do nothing as well. Okay, I hope this table is going to assist you. Let's quicken up. Now, there is this example, ladies and gentlemen. A company is engaged in a legal dispute. The outcome is not yet known. A number of possibilities arise as follows. Number one, it can expect it expects to have to pay the aggrieved party. Okay, how much? $100,000. Now, how do you treat this $100,000? If you are expecting to pay, all right, obviously you need to provide for the 100,000. You need to make a provision for 100,000. Why? Because it is probable that you are going to pay. When you are now having some expectations, it means you have reached the probability level. Okay? But because the outcome is not known, okay, so in that case the timing is unknown, right? So you just have to make a provision. But if you were knowing the outcome, obviously, but you haven't paid the amount, then obviously you just have to have not a provision but a real liability. You would be required to include it as a liability, an ordered liability. But in this case, you do not know the outcome. However, the lawyers have indicated that you are whether today or in some months to come, you are required to pay 100,000. Therefore, you are now expecting to pay. What is left is the date of the payment, which is not yet known. Okay, or the outcome of the case. Then you need to provide. What about if there are some possible damages? Okay, possible damages of 100,000. These are possible, and when we talk of possible, okay, that's the definition of a contingent liability. In that case, you need to disclose a contingent liability. So it's about playing around with these terminologies. Okay, you only have to provide when it is probable. From probable to virtual, then you need to provide. But if it is only possible, just disclose. If it is only possible, just disclose the liability. Sometimes the company it might expect to make a payment, but the amount cannot be estimated reliably. Okay, there is estimation uncertainty about the amount. So in that case, you just have to disclose a contingent liability. If expecting to pay, but no reliable estimate is available, disclose a contingent liability. So it's an issue of playing around with the terminologies. Let us try to attack this example. Question Dracha and Co. On 1 January 2008, Drachan Co. was notified that an ex-employee had started court proceedings against them for unfair dismissal. Legal advice was that there was an 8% chance that Drachan Co. would lose the case and would need to pay an estimated 1.012 million on 1 January 2009. Based on this advice, Drachan Co. recorded a provision of 800,000 on 1 January 2008 and has made no further adjustments. The provision was recorded in operating expenses. Drachan Co. has a cost of capital of 10% per annum, and the discount factor at 10% for 1 year is 0.9091. Its year end is 3rd June 2008. Let us account for this transaction. Okay, I want to highlight that this 80%, we are saying, the 80% you are seeing there is not for you to do expected value computation. It's not. This 80% only tells us that we are within the probability level. Remember, there is a remote possible from our table. Remember, from our table, we said the remote that's up to 5% or 5% or lower. Okay, less than 5% actually. I'm sure I pointed out that in the table there. Okay, so the question is showing that we are at this level. Okay, we are at the provide level between 50 to 94%. Okay, or 50 to 95% rather, right? Because virtually certain is above 95%. Okay, so 50 to 95%. Okay, so the 80% is just telling us that we need to provide, because there is an 80% chance that something is going to happen. An ex-employee is suing the company, so this is a liability, obviously. Okay, the company is expected to make some payment in the future, but there is an 80% chance that they are going to lose the case. Okay, so it's highly probable that they are going to make a payment, because an 80% chance is actually a higher level of probability. Okay, there's an 80% chance that they're going to lose. So if they are going to lose at 80%, then they are within the 50 to 95% probableness or probability. So they should provide. It's in no way a situation where you are required to do the expected value computation. Now, a lot of students could be hoodwinked by the fact that the examiner has said that this company had already provided for $800,000. Okay, that could be a trap to some students, which might force them to think that so the present value was necessary, because if we say 800,000, 800,000 is almost like 80% multiplied by 1.012 million. It's almost nearer to 800,000. But the idea here is it was, or it could be, an issue of throwing some students overboard. Okay, so let us then be systematic. We now know that the 80% then simply telling us that you need to provide, because there is an 80% chance that you're going to make a payment. So if that is the case, then let's do the normal way. Now the normal way is guided by the principles. We are told that on 1 January, that's when they were notified, okay, and they provided for the they provided for this event. Okay, now the question is, the year end of the company is 6 months from 1 January, that is 30 June 20x8. So obviously we then have to consider aspects to do with apportionment of the time value of money. Okay, we need to determine the annual cost of the issue and then apportion it to 6 months, because this is it's only a distance of 6 months from 1 January to 30 June 20x8. Okay, so what is the present value of the liability? PV of liability. We know that the liability is 1,000,000.12. Okay, that's the liability, and we have been given the discount factor at 10%, which was 0.9091. So it means that the liability should be, let me use my calculator, that's 920,000. So we are going to debit. This is at recognition of the liability. We were supposed to have debited the provision in the expense, debit provision in the P&L, the profit or loss, 920,000, and credit the liability in the provision in the SFP. This is an expense, okay? Sorry, this one is liability. So the SFP. Sorry, my machine is misbehaving. Don't know what's going on. Maybe it's tired. SFP 920,000. But we are told that these guys have already provided for 800,000. So which means we only have to the correcting entry, because this is what they should have done, this entry. However, they recognized 800,000 only. So to correct that, we just have to debit the difference. So debit provision in P&L, the difference, that's 120,000, and credit provision SFP 120,000. Okay, all right. I think that is that. But as this was the present value, okay, 920,000 was the present value. At the end of the year, we need to have the finance cost, okay, the unwinding of the discount should be done. Okay, so to unwind the discount, we need 920,000 multiplied by the 10%, and we get 92,000. So we are going to debit the finance cost, unwinding of the discount, 92,000, and crediting provision, 92,000. However, we are told that the year end is just 6 months away, so up to year end, from the date we recognize the provision to the year end, is only 6 months. So we need the correct, so this is a should have answer, but the correct entry should be debit financial costs 92,000 over 2, or multiply by 6 over 12. Okay, so over 2, this will give us 46,000, and credit the provision 46,000 to indicate half year. Okay, so actually the best way is to multiply by 6 over 12, because some examiners might be annoyed, okay, by 6 over 12, so that you bring it to their attention that we need to prorate based on the part of the year. So in the statement of financial position, what are we going to show? Because the question is saying account, so we need to as well say something about the statement of financial position extract, statement of profit or loss extract. Okay, so obviously we are going to have these entries, okay, in the statement of, in the P&L. We're going to have operating expenses. Okay, they are going to be the operating expense. Remember, I said this 120, right? Because these guys have recognized 800,000 only, all right? But we then have to add, okay, the extra, because it should be 920 according. The PV is 920, so we need to add the 120 is an additional expense, okay? So 120,000 plus the finance cost. Remember, we are talking of the finance cost of 46,000. Okay, the finance cost. Here we are not talking of any depreciation. Remember, this is just a legal case. Okay, no asset was bought. Okay, so you need to be very dynamic and dexterous. Okay, you just have to be very, very alert. Then what about in the statement of financial position? In the SFP, we are having a provision, okay, a liability. The provision was originally 920, okay, 920,000. When we computed our present value, it was 920,000. Remember, okay, is this one. Okay, that's the provision. And then what we then have to do is to add the extra cost. from the finance cost, remember. Okay, we need to include the extra cost, and the extra cost is the the 46,000, because we said we have to credit the provision there, which means we're increasing the provision, so plus 46,000. Okay, those are the entries which were required, and if you have done this, then you would have accounted for the transaction, that we would have answered the question account. Okay, you would have accounted for the transaction. I don't know. Okay, I think we just have to do a diagram about how to recognize or to account for a contingent asset. Okay, now right, so basically we are just recapping what we've done. Let's say we are having our contingent asset here, but the receipt of this asset is virtually certain. Therefore, we need to recognize the asset. However, if it is probable that we are going to receive the asset, we disclose. If these other two are possibilities, if it is only possible or remote, here do nothing. So that's how to deal with contingent assets. Okay, and what of contingent liabilities? Okay, if it is virtually certain that you're going to pay, okay, if you are virtually certain that you're going to pay, provide. If it is probable that you're going to pay, provide. If it is possible, disclose contingent asset. If it is remote, do nothing. Okay, so here we are saying disclose. Here, disclose contingent assets. This one, I'm sorry, this is it. Disclose contingent liability. You disclose the contingent liability. Okay, excuse me. What else is required is left out. Now let's talk about complex assets and overhauls. In our examination, we're likely to be confronted by situations where we need to account for complex assets and overhauls. Now, a complex asset is an asset which is made up of separate components. Each component is separately depreciated over its useful life. An example of a complex asset is an aeroplane, okay, an aircraft. This is where um, we have, I mean, a lot of parts which have got which require their own depreciation methods. Okay, they've got different lifespans and so forth. So in that case, we then have to consider that asset as a complex asset. Now, where an asset requires regular overhauls in order to continue to operate, the cost of the overhaul is treated as an additional component and depreciated over the period to the next overhaul. So, overhaul costs are actually considered an additional component. So you can see that the way we treated decommissioning costs or environmental cleanup costs is actually the same way we are going to treat overhaul costs. Okay, and these are normally common in complex assets, okay, or those assets which are subjected to wear and tear, but which are also subjected to stricter um, health safety regulations. Okay, um, stricter safety and health regulations. So they require they are required to be overhauled very frequently or on a regular basis. Okay, and when you are talking of overhaul, we are simply talking of major repairs. Major repairs. Okay, it's like to start building the asset again, but in this case you are just refurbishing the asset, but at a major level. Okay, that's almost bringing almost every part to its newer condition. Okay, so there was actually need for us to merge the aspects of complex assets and overhauls. Why? Because usually the complex assets are the ones which normally require such type of procedures. All right, so complex assets are accounted for or are even recognized by International Accounting Standard number 16. Now, let us look at this particular example and see how we can figure it out. Now, an aircraft could be considered as having the following components, right? Fuselage, which costs 20,000 but has got a useful life of 20 years. Then undercarriage, which costs 5,000 and has got a useful life of 500 landings. Engines, they cost 8,000 but they only fly for 1,600 flying hours. Management have determined that an overhaul is required at the end of year 3 and every third year thereafter at a cost of 1.2 million. Determine the amount of depreciation charged in respect of this aircraft in year 1, in which 150 flights totaling 400 hours were made. So here we are required to then understand the principle of dealing with complex assets as well as overhauls. How do you calculate the depreciation? How do you then have to deal with the overhaul of this particular asset? But like I said, the overhauls are just treated the same way as decommissioning costs and so forth. Why? Because they are considered part of the asset. Okay, when an asset requires regular overhauls in order to continue to operate, the cost of the overhaul is treated as an additional component and depreciated over the period to the next overhaul. So you can see that they are capitalized, because by being considered as or recognized as an additional component, it means they are being capitalized as to the cost of that particular asset. So in determining the depreciation, let us just follow the same. Okay, so we have got these items, these assets. All right, we need to consider them, to consider their cost. Okay, we consider their cost, and then the amount of depreciation can be then determined, prorated to the extent of their use. Okay, to the extent of their use. So can do it this way. We start with the asset on top was fuselage, right? Let me confirm. Yes, fuselage, which was 20,000. The fuselage is for 20 years. So fuselage, remember we are calculating depreciation. So fuselage, sorry, 20,000 over 20 years. Okay. That's 1,000. Okay, let's now talk of the next asset that is undercarriage, which was 5,000. Undercarriage, it was $5,000 multiplied by this. Um, it traveled how many? About 5,000, but it has got maximum landings of 500. But how many flights have been traveled so far? We can see that it has traveled 150 flights so far. So the depreciation should be apportioned based on the 500, but 1/5 have been traveled. So 1/5 over 500 flights. So that's, let me just use my calculator. 5,000 multiplied by 150 over 500. That gives me 1,500. 1,500. The other asset there is engines. They are $8,000 with a total of 1,600. So engines, we come here and say engines, $8,000 with total of 1,600 flight hours. Okay, but 400 hours were made so far. 400. So the depreciation should be $2,000. Okay, now the depreciation for the overhaul. Okay, remember we also need the overhaul. The depreciation for the overhaul should also be determined, and is in the way we computed uh, the overall costs. I mean the decommissioning costs. We then have to do the same. All right, we just have to do the same. So the cost of the overhaul was 1.2 million. Okay, now this 1.2 million is paid today. Okay, we incur an overhaul today. We pay the amount today. So every 3 years we need to pay this amount. All right, now the question that might confuse us is, shall we then have to calculate the present value of the overhaul? This is a regular transaction. Okay, it is a regular transaction. So we are only required to include the actual cost of the overhaul. Okay, so we then have to consider the 1.2 million. All right, not the present value, the 1.2 million. Okay, as I mean the discounted value of 1.2, but we want the actual 1 million. That's what we are going to use as the cost. Remember, this is an additional cost to the asset. All right, so we just have to recognize the actual overall cost which is required. So that's 1.2 million. Okay, the overall is 1.2 million. However, this 1.2, the overall is frequently required every 3 years. So we divide by 3 and we get our 400. So thus the depreciation charge for this overhaul should be 400. So we add up these figures. Okay, we need to add up the figures and we get the total. That's 1000 plus 1500 plus 2000 plus 400. We get 4.9 thousand. Okay, so just to wind up the case, let us then finish up by recapping what we've done so far. So I just want to wind the chapter by recapping the treatments which are required when you face these specific situations. If an issue is about future operating losses, then don't provide. Why? Management can do something to prevent those future operating costs. What about a onerous contract? A onerous contract, okay, you need to recognize a provision equivalent to the losses that are going to be incurred. Okay, so provide amount equal to the losses to be suffered or to be incurred. What about restructuring provision? Provide as long as there is a formal plan and it has been communicated to stakeholders. But you must read carefully the question to see that the formal plan is actually something that is tangible and the communication has been made to an extent of bringing the expectations in those affected parties that a restructuring exercise is going to take place. Now, environmental provisions, these ones have to be provided. Okay, you need to consider them as part of the cost of the asset in question. All right, they have to be let me just say equivalent to the damage expected, capitalized as cost of assets at present value. So which means you need to open an equivalent present value of the asset as well as the liability, the provision. Okay, you open two things: you debit cost and credit provision or liability. All right, so the cost of assets, that's what we are talking about here. So if it is an issue that a mine which has been acquired is likely to incur environmental cleanup costs, then you then have to say that mines the asset mines cost plus the cleanup costs that's capitalizing. So those are the debits, and then you need to then say credit the provision as well as to credit the amount that has been paid to acquire the mine. Okay, so you credit the cash as well as to credit the provision. Now, what about warrant provision? You need to provide at the best estimate. Provide at best estimate that is using expected value. Expected values usually. Overall costs, these ones are going to be no provision. No provision. However, capitalize as cost of additional component cost, or is cost of the non-current assets, right? In bracket, additional component. It's an additional component to a non-current asset. Okay, so you just have to, after you capitalize them, then you depreciate to the period of the overhaul, to the period of the next overhaul. That is the lifespan of the cost should be equivalent to the length of the next expected overhaul. So you depreciate these assets, the overall cost, over the period of the next overhaul. Now, I think we have done everything here, and we just have to, replay the videos and so forth, where you don't appreciate, or where you don't get the explanations clearly, please don't hesitate to contact me. Those are my WhatsApp numbers, and I would also want your comments so that by the end of the day I improve my offerings. Okay, so let us now meet each other in the next video on IFRS 5. Okay, and conclude this week's task. Thank you.